Well, we have our market master of the day with us. Mahesh Patil is joining us. Mahesh is Chief Investment Officer, Aditya Birla, Sun Life Asset Management Company. Mahesh, good to have you with us here. Thank you very much for your time. Mahesh, let's just get a quick sense on this entire flows picture. At a net level, what is the industry averaging at? I mean, if you can give us the latest, for this month as well. Are flows holding on both on the SIP and discretionary side, and where exactly is the money going?
Yeah, good morning, Prashant. So I think the overall in the last 3 months, we have seen that the net flow numbers for the industry have been clocking a much higher number than what it was average of last year. And I think that broader trend continues, it seems like. I think we don't have the exact number for last month. But I would say clearly the net flows still remain fairly strong. The SIP flows are strong. What is the trend? What we saw last couple of 2-3 months is that out of the net inflows, large amount of money came in the thematic funds, right? So there were a lot of these NFOs which were there on the thematic side. And that's where the larger, more than say around 40% of the inflows were in that category. But one interesting trend, possibly what we are seeing is that there is some interest coming back into the hybrid funds, and also some inflows coming into the flexi cap and the large cap category, compared to say last year, where we had seen this category was totally ignored. So I think that's a kind of a subtle kind of a change of what we are seeing. But by and large, I think the money inflows into the markets, into the mutual fund industry seems to be still on a steady wicket.
Oh, absolutely, Mahesh. That's the big trend that we've witnessed over the last couple of months now, right? Thematics is where the action is, and that's where the money is coming in. But, what about valuations? Because obviously there is product innovation on that side, and you're seeing, and now there are a lot of passive products, passive thematic funds that are coming in as well, and they're bringing in the money. So what about valuations in some of these themes like defense or manufacturing or infrastructure? Because this is where we've seen a fair amount of, newer products as well when it comes to thematic funds. So how do you see valuations in these specific pockets?
Yeah, so I think in some of the themes, clearly they have there's a lot of fancy which has been there, and we've seen a lot of money chasing some of these themes. And a broader market, if you look at it in the sectoral themes, in some of the pockets, the valuations have moved ahead. But I think some of the themes which have come in, also the outlook there, right? One has to really look at the long-term outlook on this theme is still really good. So there could be period of pause, or there could be period of consolidation in some of the themes, and investors who are coming into these thematic funds should really look at on the perspective whether where you are early in the theme or the mid cycle of the theme or in the late cycle. So clearly, if you're in the late cycle, then clearly one needs to be very careful. But even if you're in the mid cycle, I think that should still be okay if you have a slightly, say, with a 2 to 3 year view horizon. But I think I would say that it's time now to really look at more the diversified fund, right? Because as I said, in the last 1 year, we've seen that the market breadth has improved significantly. So a lot of the side of the market has gone up significantly, and which is also reflecting the fact that if you look at the number of stocks, say in the BSE 500, which have kind of outperformed the BSE 500, say by at least more than 10%, that number is the record levels. And that's because of some of the themes, the side themes which have played out. And that's where the valuations are looking a bit stretched. But if you look at the broader Nifty, right, there the valuations, if you compare to FY19 levels pre-COVID, and now it's only about 7-8% higher. So I think that's where the larger comfort is. So I think it's time where people start putting money into the more diversified fund, where the risk mitigation will be much better.
Right. I just want to quickly highlight Zomato. It's taken off like a rocket. It was not there in the mix earlier when we sort of were looking at the stocks and what was moving. But the Zomato intraday will come up on your screen, and look at that. So actually there was a lower start on Zomato, and then it has moved up to where it is now, which is a full 10 rupee turnaround coming through on that one. The other one is Edelweiss. I just want to make a quick mention. Edelweiss, I mean, the low yesterday was 104 bucks. It was a late surge on Edelweiss yesterday, ended up about, I think, 4%. It's another 3.5%, 4% this morning. So just sort of two new names into the mix this morning. But there is lots more in terms of individual names which are coming through. Nigel.
Yeah, all right. Well, hi, Mahesh. Good morning and good to see you, Ben. What's your view on these new age themes? Zomato, I think the other trigger, the technical point is that it could come into the FNO. If it comes into the FNO, then it'll be eligible to come into the Nifty as well. That's what the street is hoping. Your view on these new age themes, some of these concept stocks, Zomato, Ola, a lot of them have done quite well. Your view?
Yeah, so I think some of the new age companies, okay, we've seen now they have come of age, right? In the sense that we are seeing profitability coming in both, say, at the not only the EBITDA level, but also the PAT level. So now they are, while their growth continues to be on the higher side because they're still in the early stage of their growth or probably the mid stage of their growth. But I think now we are able to value at least some of the companies which have now been there for some time and are turned profitable more from a traditional valuation matrices which are there. But I think then again in the new age company, we have to be careful in terms of really looking at whether the unit economics are really making sense, right? So if the unit economics are not in place and at the unit level you're not making a profit, then we would be slightly wary about that in terms of trying to enter that and taking any large position over that. But a lot of these names which are there, which have now established unit economics and have got the scale and size, and more importantly, established their dominance, okay, at least in their space where they are. So I think these companies are now where investors can really look at it. And obviously, since these are high growth companies, high value, we have to be careful in terms of when we are entering into. And on a quarterly basis, one needs to monitor in terms of what is their delivery, if they are really sticking to their growth or they're faltering, because here the volatility will be much higher, right? And if they falter on growth in any of the quarters, I think you could see a larger derating. So that's where investors need to really keep in track whether they are really tracking the kind of performance or the expectations which the market has from these companies.
The market's come off, right? I mean, 25 odd points is what you have on the index, 25,200. So just about holding. And we were saying this, I mean, the global picture is, I mean, at least the handover was better, but it's neither here nor there. Generally, the big data point out of the US is tomorrow's jobs number. And markets would be broadly quite wary about sort of going big one way or the other before that number. And that is only, of course, around the time that the US markets start to trade on Friday. So it's a bit quiet overall so far as far as indices are concerned. Edelweiss is now up 6%. So that's actually, flying now, 121 on Edelweiss. But there is so much more. Kaplan Point is up 4.5%. You've got Kernex, I mentioned. Craftsman Auto is up about 4%. So 62.52 on Craftsman. I could go down the list, but volumes are still about picking up. But this is the bulk of what is going on out there. Mahesh, just a quick view on banks, but more importantly, NBFCs, right? I mean, if indeed we are in that point where rates will start to come off, what do you think? Should one stick with some of the larger banks, or do you think it makes sense to look at some NBFCs, etc., as well? On the housing side, companies are keenly awaiting how this new PMAY 2 will work. So that'll be important for them. But generally, how's the environment? And what is a better bet right now? Some of the NBFCs or large banks?
Yeah, so I think one is, I think we are now getting into the rate cut cycle, right, which will start shortly. I think you will see that now in this month in the US, okay, the Fed move, I think that will kickstart the rate cut cycle. And that should be positive for the NBFCs, I mean, additionally, because where you will see them benefiting on the cost of fund side. But I think more important on the financial services side is to look at on the two aspects. One is on the asset side, right? So I think NBFCs, okay, which are, because asset quality cycle has been fairly benign at this point in time. And there are some pockets of risk which are coming up, okay, at this point in time, especially on the unsecured side, which one has to be careful. So I think NBFCs which are doing pretty, on the asset side, good underwriting, more on the secured book, right, which is the vehicle finance book or the mortgage finance book. I think the comfort would be much better. Also on the liability side, again, we've seen that there has been some of the challenges, at least from the bank lending to the NBFCs. So the stronger and the larger NBFCs, I think, are where they will continue to get advantage in terms of the liability side, both on the cost of funds and also in terms of the supply of funds over there. So I would say if you're able to categorize NBFCs, the larger ones, the stronger ones, okay, on the asset side, which are but secure lending, I think those should do fine in this rate cut cycle going forward. And as far as the banks have concerned, larger banks, I would say that the rate cut cycle will plays out. You might see some margin pressure, okay, which could be there, but I think they have already kind of discounted, I would say, because the underperformance in bank for the last 1 year, what we've seen is pretty much there in the price. And it's more to do with your credit growth, how that picks up. I think that will drive the outperformance in the banks.
All right, Mahesh, we'll leave it there. Thank you very much for your time. It's really a pleasure having you here and getting that perspective across. So